Hello and welcome to this week's special presentation. My name is Jim Penna. I'm the Manager of Retirement Services here at VectorVest, and I'm excited to be hosting this week's topic, which is titled 7 Secrets to Making Money with VectorVest, Secret Number 5, Learn to Trade Options. Our founder, Dr. Bart DiLiddo, has delivered the presentation 7 Secrets to Making Money with VectorVest many times over the years, and it is the crown jewel of VectorVest presentations. It has everything an investor needs to know to achieve consistent success in the stock market and ultimately financial freedom. In this presentation, we will revisit secret number 5 and show you how you can begin to achieve financial freedom when you learn to trade options. So let's walk through the key principles and the key advantages of learning to trade options. First of all, options provide leverage. They reduce risk. Options also give you the power to lower costs and to generate income. And finally, increase alternatives in your investment process. So these key advantages are very important, and what my goal here in this presentation is to, again, show you why it's important to understand these trades. I'm going to show some examples for each of these as we go through. Some will be modeled trades, some will be trades we actually have done in our retirement coaching group. The key to taking advantage of all of these characteristics is that the options must be used properly. So let's start here. Options are financial instruments that can provide you, the individual investor, with the flexibility you need in almost any investment situation. Quick definition of an option contract: understand that it is a security and it trades just like a stock. It's got a bid price and an ask price. There's market makers who are tasked with providing fair and orderly markets. So in that sense, it trades just like a security. It is a negotiated contract with strictly defined terms and conditions. Now, stock options provide the owner of the options the right, but not the obligation, to buy or sell units of 100 shares of stock at a certain price by a certain date. And these are the strictly defined terms and conditions. So from there, let's start with provide leverage. This was the key advantage here I want to talk about. Now, when you talk about leverage, the first thing a lot of folks will think about are margin accounts, and they generally provide in your mainstream broker a 2-to-1 leverage. Okay, unless you have a pattern day trading account, they may allow up to 3 or 4 times the leverage. But what happens is it increases both risk and reward. Now, options can provide up to a 10-to-1 leverage and reduce risk when used properly. And a fairly priced option with 4, 5, 6 months to expiration will generally allow for that 10-to-1 leverage. So let's take a look how important leverage is, and I want to walk through a modeled trade here that I want to share with you. So we're looking at STLD, it's Steel Dynamics. Now the trade date on this modeled trade was on October the 18th, 2022. I went out and took a look at the VectorVest program. We checked the market timing indicators. On 10/18 there was a green light in the price column, the VectorVest color guard. Not only that, it was confirmed by our RT Kicker combo. In other words, we had confirmation of a bullish bias on the overall market on that day. The process took us into the VectorVest program. I looked up some of the good quality searches that I like to use for my investing and option trading, and STLD came to the top of one of those searches. With the stock trading at 81.61 on that day, we went out and bought a December 80 strike call option and paid $7.50 per share, or $750 for one contract. And you can see those numbers here. We bought the December expiration. Again, this trade was set up on October 18th. Now, what happened to this trade? Well, as we click through, we can see that on 10/25, just a week later, that one STLD December 80 call at $7.50 per share now had a profit of $1,123 per share just a week later, because the bullish bias had played through and the stock continued to rise. So that's obviously greater than a 100% return on the initial investment. Had you continued to hold the trade into November, you would have had just under a $2,000 return, as you can see over here. And then, of course, this example goes up to December the 7th of 2022, and you could have been up just about $2,200. So that's kind of what that model trade looked like, aligning a trade using leverage. And let me illustrate the power of the leverage on this particular trade. So this chart will show us, again, I think give a good visual of the power of leverage. Had you gone out and bought 100 shares of STLD, the initial cost, again, was $81.61 per share, or $8,161. The value of the stock at the close of trading on December 7th was $107.50. Okay, that's a $10,750 value on your position, which is wonderful. Your profit was $2,589 with a 31.8%, when I round that, percent gain. Wonderful, great trade. Using the VectorVest program locks that in for you. But let's take a look at the power of leverage. Had you bought one contract at $7.50, that's $750 that you laid out at capital outlay. The value of that option on December the 7th at the close was $27.80, was the mid price of that option at the close of December 7th. That's a net profit of $2,000, $2,030. Now, when we talk about leverage, right, $750 plus 270% will bring you, again, I rounded that, $2,030 net profit. That's just on one contract. Now, yes, you would have had a little more profit here, right? But you had to outlay and risk over $8,000 to do that versus the $750 here. What if you had gone 3 contracts? The power of leverage still shows us that we're paying just a third of the price than the initial price of buying the stock. But look what happens. The value there is $8,340. That's over $6,000 profit. Again, 270%. And then once you're comfortable and you're very confident in a position, you can go all the way up to 10 contracts, still spending less, and then the numbers really begin to increase. So again, when done properly, the power of leverage is illustrated here in our STLD trade. The next advantage that we saw and why we learned to trade options is to reduce risk. Right? We can reduce risk using options as an insurance policy. We can buy put options, or there are other trades called a collar trade, where you can protect an individual stock position or your entire portfolio. For now, I'm going to talk about buying put options to help reduce risk as an insurance policy for your portfolio, or actually to profit in a downtrending market, as we'll talk about as well. So let's take a look. Now, this is an actual trade done in our coaching group here, and the trade was initiated on September the 20th of this year. The VectorVest market timing indicators were telling us it was time to protect our net worth. So we went out and bought 2 SPY, that's the ETF that tracks the S&P 500, and we bought 2 October 384 puts and paid $10.99 per share, or $21.98 for 2 contracts. Again, these numbers are laid out here. Well, what happened? The market did begin to fall, but in this case, our risk management techniques had us out with over 100% gain just 3 days later. The market really, again, during this downtrending market, went down significantly, and the risk management techniques we use had us with 100% gain out of the trade. And that's a great way to reduce risk for your overall portfolio, or again, profit in a downtrending market. We did it again just a couple of weeks later on October the 5th. This, again, a live trade, bought 2 SPY October 375 puts, paid just about $9. And again, the same thing happened, right? It was only 6 days later we sold those with, again, another return on investment of over 100%. So aligning these trades using the VectorVest timing indicators is a great way to reduce risk and or profit in a downtrending market by understanding the power of using put options. The next item was lowering costs, right? So we're going to talk about selling covered call options in a moment. You can also sell put options on stocks that you might be willing to purchase. Let's take a look at an example of selling a put and some of the outcomes that we can see. Now, I'm going to use the same STLD model trade we used earlier. We bought the call option and the stock moved higher, and it worked out well, and we saw the power of leverage. Here, we're selling a put, right? So we're short a put option. In this case, I used two contracts, selling the December 60.75 strike when the stock again was trading at 81.61. So instead of putting that limit order in where I could just wait to buy the stock if it pulls back because I like STLD, I can actually get paid to wait. And I'm going to get paid in this case $3.60 per share to be obligated to buy the stock at $75 a share. Remember, it's trading at 81.61. I like the stock, but I'm not willing to pay that. I want to buy it a little cheaper. So I get paid to wait. What would have happened had I placed this trade? The stock rose, as we saw earlier, had a nice move to the upside, and the stock rose. So what happened is I'm able to keep the premium, right? That's $710 at expiration or right up till December 7th. But I could choose, obviously, to close the trade anytime I want to take in profits anywhere from $500 to $700. So the stock goes up. The stock could go down, and our break even here would be from $75 strike minus the $3.60. So this stock could go all the way down to $71.40 before I start to lose any money on this position. Okay, so it's a great way to go in. Now the issue is here that you're buying a stock that's falling in price. So the risk is inherent in the fact that you will ultimately own the underlying stock. So there are risk management techniques that would be put into place. And I'll show you in a bit the power of credit spreads and show you how to mitigate that concern. But that's the beauty of a short put, how you can get paid to wait to buy a stock at a lower price, and it lowers the cost of that purchase. The next item was one of my favorites that we use in retirement services is generating income. We talked about selling covered calls to lower costs. When you sell covered calls against stocks you already own, you're lowering the cost basis every time you take in a premium. They can be used as a defensive measure. Here to generate income, what I want to illustrate for you on the covered call is what's called a buy right, and then we'll take a look at credit spreads. First, let's take a look at the covered call. This on Occidental Petroleum was an actual covered call that we executed in our coaching group back on October the 4th. Using market trends, using the proper searches to find the best underlying candidate, we found Occidental Petroleum. We then used our filtering techniques to set up the proper option trade, and in this case we went out and bought 100 shares of Occidental at 66.16, and we sold one call option, a 70 strike, so it was out of the money, at $3.58. What does that mean? I own the stock at $66.16. Someone else paid me for the right to take away my stock at a higher price. Okay, that's basically the definition of a covered call. So what happened in this particular case is they paid me, and the stock, although it had a little volatility early on, began a nice move to the upside. And here's again the setup for the trade. We purchased those shares of Oxy, sold the November 70 call. This is known as a buy right. That left us with a cost basis on the overall position of $62.58. That's 66.16 minus the 358 that we got paid. This is the cost basis now for this trade. What happened? Well, 3 weeks later, I went back and bought the call and sold the stock simultaneously, same way I purchased them, at an aggregate price of $67.12. That's a 7.25% return on investment in 3 weeks. When you're looking at the objective of generating income in your portfolio, these are wonderful trades to make when used properly. And this was an actual trade that we profited from. Let's go back real quickly because part of that was also talking about selling credit spreads. So all I'm doing here is taking the Amazon example we had just earlier, right? I like Amazon. It's trading 89 and change. I can go out and buy the stock at 89, but I don't want to pay that much. I can put in a limit order to buy it at 85. Well, as I talked about, I want to get paid while I wait. So I sell a put option. I sell someone else the right to put that stock to me at 85. Now, remember I said that the risk there is you're buying a stock that's going down and theoretically the stock could go to zero. But what did I do here? Well, I went out and bought a 75 strike. Now there is due diligence to be done here on the individual stock and the actual setup. Please understand I'm just showing these numbers to give you an idea of how it works. So understand that as I go through it. But I went out and I bought a put option, which gives me the right to sell the stock at $75 per share. So what did I do? I took in 302 per share. I got paid that 302, and then I went out and used 91 cents per share of that, right, to buy insurance to the downside should the stock go. So here are the important numbers over here to the right. The break even is now $82.84, right? Remember, the stock's trading 89.5. Again, if the stock just continues to rise, I'll get to keep, in this case, $216, again, depending on which contract you bought and sold. But in this case, for this example, I can make roughly $215 on the trade. If the stock is put to me, my break even is all the way down to 82.84, and I would have risk management techniques in place to manage that trade afterwards. So that's the covered call and the power of credit spreads to be able to generate income by using options. Just another powerful concept of understanding and why you should learn to trade options. And then finally, we talk about increasing alternatives. Using options, you can make money whether a stock goes up or down. One trade that allows you to do that, a trade I know Dr. DiLiddo used to enjoy talking about, was buying straddles. Right? A straddle, what is that? Well, it means you go long calls and long puts at the same time. The strike price and the same expiration date. Let's take a quick look at what that is. So all that means is that you're looking at a stock, and again, I'm just using Amazon as the example. You're looking at a stock that you believe maybe an earnings report is coming out or some other type of news is coming out. You believe the underlying stock is going to move significantly one way or another. You just don't know which way. So if you want to place a trade on that and take advantage of what you believe is going to be a very large move, you can buy a call and buy a put at the money, same strike, same expiration. And this is the effect, right? So again, in our Options Pro software, we can see the solid lines are at expiration. If the stock doesn't move from $89, right, you will have your max risk, you have your max loss at just over $1,000. But as the stock either moves up or down, that's when your profits come in. Right? We have break-even points to the upside and downside. So you need the stock to move to at least $99 to the upside or 78. Again, this is at expiration. During the life of the trade, if the stock moves down, you will make money. At expiration, it would have to be below 78.72 or above 99.28. But just another great way to take advantage of this. And when we talk about increasing alternatives, right, let's look at just some of the trades that, it's a neutral trade because I don't know which way the stock's going to move, right? There's so many alternatives to play the market. Again, the versatility and flexibility of options is virtually endless. So it's important to understand you may not use all these trades. There's so many trades, but once you have your objectives and the trades you're comfortable with, right, that ability to apply these trades is only going to make your investments easier to protect, easier to grow when used properly. So to wrap things up, why learn to trade options? Well, again, because they provide leverage. They reduce risk, lower costs, help you to generate income, and increase your alternatives investing in the market. But please remember, they must be used properly. So that is our revisit to secret number 5 and how you can begin to achieve financial freedom when you learn to trade options. If you're interested in learning more about trading options, if you're new to options, I'd like to take a moment just to talk a little bit about our Options Jumpstarter course that's beginning next week. It's called Options Jumpstarter, 6 Weeks to Profitable Option Trading. It's a complete step-by-step system that shows you how to buy calls and puts to profit in both up and down markets. We will take you through the exact step-by-step option profit system that you need so that you can leverage your money with options. The outcome of this course is in the next 6 weeks, you'll be able to confidently find, set up, and manage the right option trade at the right time to make money whether the market's going up or down. So if you're new to options or have struggled with them in the past, this is a course for you. We put this course together for people who want a system to trade options the right way. The Options Jumpstarter course is found in the VectorVest University. The self-paced modules are there for you. It's a 6-module course. Module 1 simply builds the foundation, the building blocks for you, definitions, and some of the important things you need to know about options. We then begin to set up calls for both up markets and down markets, how to profit in either of them. So we talk about calls in Module 2, preparing using the proper alignment with market timing, how to set up the trades and knowing the situation on both, and the same thing for downtrending markets. Module 4 is about trade selection, picking the best candidate. We identify the best underlying asset to buy a call or a put on, but we have to be sure that it is also the best option candidate. So there's certain option criteria, characteristics that we need to see to filter through. And then finally, once we've set up our trade and enter our trade, to be successful, we have to know how to manage that trade once we're in it. We have to be prepared and know what to do. So we set objectives, profit targets, exit criteria. And then finally, we show you how to enter trades, how to exit trades. We have a trading checklist. Right? We have some great tutorials and educational videos with different brokers, and we walk through those during the course. Go to vectorvest.com/jumpstart to sign up for the course. There's a bonus in the mastery package. We have 6 live mastery support sessions that start on December 21st. So you have time to watch the modules. In the mastery sessions, we help you implement what you learn in the modules. We look at what you're doing, answer any and all questions, and if you can't make the live session, don't worry, we record it that day and put it into the VectorVest University for each module. So the special price ends Monday, December 12th at 5 p.m. Registration for the course will close on the 13th at 5 p.m. Again, when you go to vectorvest.com/jumpstart, simply click here and it'll walk you through the process and save you on the regular price here. That $495 price will end Monday at 5 p.m. An important factor here is this. After the course is over, if you show you've done the work and you're not fully satisfied, we'll give you your money back. We'll give you a 100% refund as long as you have shown that you've done the work, watched the modules and all, and you're not satisfied. That's how confident we are. So basically, it's a risk-free trade for you, right? There aren't many of those out in the market. Go to vectorvest.com/jumpstart, and we look forward to seeing you at the Options Jumpstarter course. So thank you for taking the time, and we look forward to seeing you next time.